Nobody teaches you this about money, so we're going to have Rob answer these 5 questions that everyone's secretly asking.
I'm in the hot seat today.
So our first question, Rob, is how should someone start budgeting and actually stick to it?
That's a great question. Budgeting is the number one searched on Google in terms of sort of financial awareness. Mm-hmm. And it's a key hot topic today, especially in the world that we live in, right? High inflation, everything costs more than it should. How can we get ahead? We're going to talk about that. But essentially, the best way to think about budgeting is there's a method and a formula called 50-30-20. Mm-hmm. So it's your after-tax income. You take 50% of that should be for your needs, right? So whether it's your rent or your mortgage and your cars and everything else, electric, utilities. So that's in the 50% bucket. The 30% bucket is wants, sort of your lifestyle things and having some fun, maybe some clothes here and there. But the 20% is your savings. But that's the most important, Madison. And here's why. In fact, when you do budgeting for yourself, and in fact, when you automate your finances, by that I mean most Americans should probably take some time to do this, and you probably don't, but it'll save your future self, if you will. And automation is that when you have your after-tax paycheck hit your bank account, set up another bank account that automatically takes out 20%. Or if you're working and employed, have your payroll already withdraw that money and put it into your IRA, your 401k, your Roth savings account. So what we call in our industry, it's called pay yourself first.
Right.
That's the key, right? If you don't see it hit your bank account, then you won't spend it. Right. You won't go all the way down. Or if it hits your bank account before your employer has the option for you to, take out that pre-tax savings sometimes, or even after-tax savings, depending upon if it goes into Roth.
Yeah.
Then if it goes in your bank account, you set up an automated bank account side by side or an investing account, Fidelity, Schwab, and it automatically withdraws and have that systematic withdrawal on a monthly basis. Your paycheck hits, then take out that 20%, put it in your investing account. The first should be savings. And then after that, you can start investing as it builds up, but it's also an emergency fund as well. So it's the 50-30-20 principle of budgeting.
I love that. Pay yourself first.
Pay yourself first.
Our second most searched question is, how do I pay off debt faster?
Yeah, another hot topic. First and foremost, everyone has credit card debt. Okay. The key there is not to ignore it, actually tackle it head on. And what you want to do is not ignore your bills, actually just get into this mental mindset of like, okay, I know I have debt. I'm not going to ignore it. Let me tackle it. So if you have multiple, let's say credit cards, one of the keys that most people don't realize that they can do and empower yourself is call your credit card company, even if you have a higher balance, and ask them to reduce your APR, so what they're charging you on a monthly basis on your interest balance, okay? Because sometimes it's up to 24, 25, 26%, which is so hard to get out of that credit card debt. I mean, you're basically now financing something you bought a month ago on 20% interest.
Yeah.
Right? It's insane. And so even the investment markets can't keep up to what you're now carrying as a debt load. So most Americans are underwater as it relates to that. So one, call all your credit card companies and just have a conversation. Ask them what they can do for you, because they work for you theoretically, right? And they want to keep you as a client or a customer.
Right.
So whether it's balance transfers to 0%, you can use those tricks, if you will. But there's also the waterfall method. And that specifically is you pay your highest credit card interest off first. Doesn't matter your balances. So even if you have a high balance on one and it's a low interest rate that they're charging you, and a lower, let's say, balance on another credit card, but let's say it's 20% interest, kill the highest interest rate you're being charged first. Mm-hmm. So you just go pay the minimum payments on the others, and you concentrate on killing one credit card at a time. It's called the waterfall effect. It kind of works if you are disciplined about it, but you're very conscious about it. So you can't keep your head in the sand. You have to basically just attack your finances with some vigor, confidence to know that once you can't manage what you don't measure in life. So you got to measure where you are, get a baseline understanding, create an action plan, do the budget like we talked about, and then prioritize sort of the interest, if you will. And that's sort of the key.
Okay. That is also important. Our third question is, how much should I have in savings?
The typical savings rate in America is like less than $400. Like no one has like a savings emergency fund. Mm-hmm. It's terrible. But that being said, the industry standard is 6 months. Like before you start investing, you should have like 6 months savings for if you lose your job, if you change jobs, if you move, if you have, something goes wrong, medically speaking, you need to help out a family friend. That aspect should be 6 months of your salary in a savings account. Now, realistically, can you get there? Even if you get to 3 months, that's important. At the same time, you're still saving for tomorrow. So, take your after-tax, pre-tax dollars out of your paycheck, still keep saving for that, but also save up enough in sort of a bank account. This is not an investing account. This is like, put it in the bank, maybe get some CD money on it, in terms of interest.
High yield savings accounts.
High yield savings accounts are great for that. Exactly. But just keep working on saving yourself for the future potential what if scenarios. It'll help you sleep well at night, reduce stress within relationships. I think that's a big key as well with regard, finances within couples as well. So do yourself a favor and start saving, put in a high yield savings account, like you said.
Okay. Our fourth question is, how do I start investing without losing money?
So investing on the short term, markets are volatile, right? If you look at the news cycle, it's not even every 24 hours now. It's every 2 minutes. There's a negative tweet, a geopolitical event, something to be concerned about, a company missing their earnings, the stock goes down. So in the short term, you should not be thinking about making money on your investments. You should be thinking long term. Okay. Long term is more than 2 years, preferably 5 to 10 years when you're investing. Number one. Number two is the easiest, best way, open up an investment account. Again, Schwab, Fidelity, one of these, and you just dollar cost average. And what that is a little bit per month. And you can put it in an S&P 500. So Standard & Poor's top 500 companies in America that are constantly waking up every day, growing their company, beating their competition, increasing their shareholder value. So they're working for you when you invest in the top 500 companies in America, theoretically the world, if you will. And it's one of those things where you just systematically, monthly start investing. And so there's going to be some months that are up, some months that are down. But over the course of time, you're going to get a higher rate of return than you would in the high yield savings account. You're going to grow your money. It's going to compound. And then you don't have to worry about the timing of the market, if you will. And that's where the dollar cost averaging helps smooth that investment ride. Realistically, that's what Wall Street does. That's what investment professionals do for our clients. And that's the smartest way to do it is like, don't jump in all at one time, do a little bit at a time, because there's months where the markets are up. There's months when the markets are down.
Right.
But if you take the average, it's going to work in your favor.
Right. That's great advice. Okay. Our fifth and final question is it better to save or invest right now? There's a lot of uncertainties in the market right now. Do you think now is a good time for people to invest, or should they be saving in a savings account right now?
Madison, the first question I'll ask you is, how old is that person that's looking to save or invest, right? The younger you are, obviously we want your savings, like I said before, 3 to 6 months in savings, high yield savings, protect yourself and have money for a rainy day, what if scenario, emergency fund. Beyond that, the younger you are, the better it is to start saving right away. Because as Einstein once said, use the eighth wonder of the world, and it's the power of compounding. So the younger you are, the more you accumulate. What you want to do is accumulate shares of, let's say, the S&P 500 index. That's what I was discussing before. At this age, investing is better than saving. It's, using compounding over time and dollar cost averaging into the market and, just taking care of your future you.
Right. The only free lunch in investing is time in the market.
That's right. Yeah. That's right. All right, Madison, since we just discussed, you put me in the hot seat, rapid fire questions. Hopefully it was, valuable for our audience. I'll leave, we discussed sort of Warren Buffett earlier. We'll talk about, one of the greatest investors of all time.
Right.
Interestingly enough, he didn't become a billionaire until he was over 50 years old. So he used power of compounding, and it took him a while to get there. A millionaire, then, so it was like amazing, right? So one of the great quotes that he has, and I'll leave this for everyone: someone is sitting in shade today because someone planted a tree a long time ago. So take care of your future you, start saving today for your future you.
That's a great quote. Everyone, thank you so much for watching this episode. Please like, subscribe, and look out for the next episode. And also let us know if there's any other financial questions that you want us to answer.
This podcast is brought to you by David Field Producer. It is produced and directed by David Field and Kristen George. And it's mix, edit, and socials by Kristen George and Sam Aguirre.
Blanky Schein Wealth Management is a group of investment professionals registered with Hightower Services, LLC, member FINRA and SIPC, and with Hightower Advisors, LLC, a registered investment advisor with the SEC. Securities are offered through Hightower Securities, LLC. Advisory services are offered through Hightower Advisors, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinions, news, research, analysis, prices, or other information contained in this research is provided as general market commentary. It does not constitute investment advice. Blanky Schein Wealth Management and Hightower shall not in any way be liable for claims and make no expressed or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements or errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This document was created for informational purposes only. The opinions expressed are solely those of Blanky Schein Wealth Management and do not represent those of Hightower Advisors, LLC, or any of its affiliates.